Welcome to RBC's Markets in Motion podcast, recorded June 16th, 2024. I'm Lori Calvasina, Head of U.S. Equity Strategy at RBC Capital Markets. Please listen to the end of this podcast for important disclaimers. 3 big things you need to know. First, the continued outperformance of mega-cap growth stocks has been logical, but still a little jarring to us. Second, small caps broke to clear new lows relative to large caps last week as risks piled up, including a Fed that seems inclined to cut just once this year. We'd stay on the sidelines with small caps for now. And third, investor sentiment continues to concern us, and we've added consumer sentiment to our list of worries for the stock market following the Michigan survey miss. One offset is that the U.S. may benefit from safe haven seeking if flows to European equity funds deteriorate. If you'd like to hear more, here's another 5 minutes. While you're waiting, a quick reminder that the 2024 Institutional Investor All-America Research Survey is open. If you found our work and this podcast helpful over the past year, we do hope you'll take a moment to vote for us in the portfolio strategy category. We absolutely hate asking for favors, but the financial community does take the results of this poll very seriously, and every vote matters in this highly competitive category. Now let's get into the details. Takeaway number 1. The mega-cap growth trade surges again. The most striking chart in our deck this week highlights how the biggest market cap names in the S&P 500 have continued to outperform the rest of the S&P massively, despite the recent decline in 10-year Treasury yields. With this recent move, the close positive correlation between the leadership of mega-cap growth stocks and 10-year yields that has been in place since the regional banking crisis in early 2023 does appear to be decoupling. So what's driving the mega-cap growth trade instead? One thing we've been writing about is that GDP forecasts are headed to below trend levels and have stopped improving, which tends to be a better environment for large cap in growth than small cap in value. Additionally, better earnings revision trends for the biggest names at the end of last reporting season did return. We're also seeing less pressure from crowding per CFTC's weekly data on NASDAQ futures positioning. The renewed strength in the mega-cap growth trade makes sense, but it is still a bit jarring to us given that one big issue driving it seems to be that fundamental tailwinds are dissipating a little bit with some headwinds emerging. Moving on to takeaway number 2. Small caps sink as risks pile up. Last Wednesday was a pretty confusing day for U.S. financial market participants. It began with a surprisingly dovish CPI print and ended with a surprisingly hawkish Fed meeting. The charts we were watching on our screen all day, particularly during Powell's press conference, track the ratio of the Russell 2000 relative to the S&P 500. By the time the day was done, small caps had given up almost all of the outperformance they'd banked relative to large caps in the early hours of the trading day post the CPI print. As the week wore on, investors digested the reality of a Fed leaning towards only a single cut later this year, challenging political dynamics in Europe, and escalating concerns about the impact of inflation on the U.S. consumer. Though the S&P 500 itself held up fairly well, it was all too much for small caps, which sunk to a new low relative to large caps, a much lower relative ratio than what we've seen in recent years. We've been neutral on small caps relative to large caps, noting that while CFTC positioning for small caps has looked compelling, down around SVB lows, and relative valuations for the Russell 2000 versus the S&P 500 have been cheap, the Russell 2000's own PE has been looking only average. Slowing GDP growth forecasts to below average levels have also removed an important tailwind for the small cap trade. We've also pointed out that earnings revision trends have been stronger for large caps lately, and that small caps typically only outperform after Fed cuts begin, not beforehand. All that being said, we continue to think investors shouldn't overthink the small cap call. We see enough that looks interesting to stay neutral for now and think that when it's time to finally put on Fed rate cut bets, this space will do well. But we think it's unwise to move back to an overweight until the beginning of the cutting cycle is closer and economic tailwinds strengthen again. Wrapping up with takeaway number 3. What else jumps out on our high-frequency indicators? To begin with, investor sentiment continues to worry us a little. AAII net bulls continue to flirt with readings close to 1 standard deviation above the long-term average. CFTC positioning on the broader U.S. equity market, meanwhile, also continues to look pretty stretched, driven by elevated positioning in S&P 500 futures. Additionally, consumer sentiment is a new worry on our radar. Our review of earnings call transcripts and presentations at RBC's Consumer and Retail Day have been indicating that inflation and interest rate pressures on consumers had been escalating. But Friday's big miss on Michigan's consumer sentiment survey was still very concerning to us from an equity market perspective, as performance for both the Russell 2000 and S&P 500 on a year-over-year basis has been tracking moves in this index quite closely in recent years. Sector-wise, it's worth noting that communication services, financials, and industrials within the S&P 500 have been most aligned with consumer sentiment over time. In this context, it wasn't surprising to us that industrials was the worst performing S&P 500 sector on Friday. By contrast, tech tends to be one of the sectors that trades most inversely with trends in consumer sentiment, offering another reason for old market leadership to return. And finally, in light of the political developments in France last week, we're keeping a close eye on EPFR's flows to European equity funds. These had been improving and were back in slightly positive territory. We wouldn't be surprised to see those turn negative in coming weeks, however, which could be accompanied by improving flows to U.S. equities as investors seek safer havens. We'll end with one more reminder to vote in II. Mercifully, that election will be over much sooner than the U.S. presidential election as the II survey closes on June 28th. That's all for now. Thanks for listening, and be sure to reach out to your RBC representative.
This content is based on information available at the time it was recorded and is for informational purposes only. It is not an offer to buy or sell or a solicitation, and no recommendations are implied. It is outside the scope of this communication to consider whether it is suitable for you and your financial objectives.